Howard Lindzan is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions and securities discussed in this podcast.
Hey everybody, really excited today. You can see it because my friend Morgan Housel is in the house. He's in Phoenix for the Wealth Stack Conference. I invited him over to be on the show. We're going to talk about Motley Fool. We're going to talk about investing. We're going to talk about writing and the collab front. So fasten your seatbelts. I have one of my favorite people on the internet in the room, and part of Lindzanity is it's not about how big the person is. You were asking me, what was the biggest guest I've had on my show, and I told you, like, you and back-to-back now, you and Patrick. So welcome to the
Thanks for having
Lindzanity.
me. Good to be here.
So Morgan Housel, Housel.
That's right.
What is that?
Do you normally do that with a guest?
No, because I don't know what I was saying nationality.
I mean, I'm a mutt in a lot of it. There's nothing really that sticks out, but it's an English,
American?
It's an English name.
Okay, it's an English name. How many kids how many brothers and sisters?
I'm the youngest of three.
So there's three of you. Were born where?
I was born in the Bronx in the early 80s when the Bronx was a third world country.
And did you like the Bronx?
Well, I lived in the Bronx till I was 2, and I lived in Rochester, New York till I was 6, and then we moved to California after that.
Okay, so Morgan, for people who don't know him, you'll get to know him here today. Is the mic okay? Sound's coming through okay? Is my favorite thinker / writer / great story on how you kind of moved up your arc of your career to kind of living the life that you want to live, all through the power of the word and writing. And we don't talk that much, so you don't know how fascinated I am with the idea of writing.
You write almost every day.
I write every day, but I'm not a writer.
But you know what I like about your posts is that they're very short.
Because I'm not a writer.
But that is the key to good writing is brevity.
Yeah.
And you
Twitter
do a better
was
job
why I
than
love
almost
Twitter
anyone.
at 140 characters.
Everyone gets frustrated when they click on a blog post and then they kind of size it up by scrolling down. You realize it's going to take you 20 minutes. Everyone just kind of, ugh. But with your post, I look at it, I'm like, I can read this in 9 seconds.
Yeah.
It's great.
And the point is, why should you have to? I know so many of these VCs that write these long posts, and I'm like, this is not a forum for you to pontificate when each company is different. If you can't, like Fred Wilson can do it, if you can't explain what the problem with the board is, what the problem of this is, and you got to bloviate, then you're that board member that's bloviating at the board member.
Absolutely.
And
but
no one's learning anything.
It's also a barbell, too, because there is a good market and a need for long-form content.
Of course.
But doing long-form effectively and doing it right is very difficult.
Yeah.
I think a blog post,
I could write long-form, too, but I'm like, I want somebody to read it.
Yeah.
And even for me, my judges, my daughter, and my wife, they like it.
Yeah, no, that's good. And even a lot of posts and books that are really good, and I like them, I'll read half of it and be like, okay, I got it, I'm done.
I know. I'm so mad at myself because I buy books and I start in, and I think the only 2 books I've read of the last 20 years that got through it word to word are like the Agassi book.
Okay.
Which I don't think he wrote, but it was well ghostwritten. Yeah. And the Shoe Dog book.
That's a great book.
I'm embarrassed, though. Like, I should be reading books.
No, I don't think that's bad. There's a great quote from Charlie Munger where he says, I'm not burdened by bad books. You should not feel guilty to start a book and either say, this is dumb, I'm going to stop reading, or say, this is good, but I got enough. I don't think anyone should feel guilty about that.
I should say I like Kramer's first book.
Street Addict.
Yeah. I mean,
you know my old...
Can't believe he didn't go to jail.
You know what my old AIM... screen name was Street Addict.
Yeah.
Came from that.
I got to say, he was one of my. I mean, he was an entrepreneur.
Yeah.
Well,
I guess
I'm just enamored with the whole thing. It's just because the whole TV and makeup is like he could have been.
The fact that he was a successful hedge fund manager and then probably more successful media guy. Of course he did.
I think he's underachieved based on his access.
But wasn't that the kind of story in the 90s? Like if you got access to the IPOs, which not everyone did, but if you had that access, it was just off to the races.
No doubt. But I'm saying in terms of like celebrity, he came from nowhere. He had all these mad skills. He knew how to write briefly.
Yeah.
All day. I was a super fan.
Yeah.
And that was the first person I was a super fan of. Like I grew up without, I liked Supertramp, I liked certain weird things, but Kramer was the first guy that inspired me, and I'm like, man, the stock market's cool.
And he was like the first modern financial personality, because before that, who came before him?
Hated it.
Louis Roykaiser. That was like the other. So Kramer was the first guy who kind of set the stage for everyone else. Of like, you don't have to be Louis Roykaiser in a suit speaking like, really formal button up. You could kind of be this online rodeo clown, and people actually like that.
But he wasn't a rodeo clown at the beginning. I would read his...
No, he's always been.
Okay, well, then I didn't know, because I used to read him before Street.com and Smart Money, because back when I read magazines, I would wait, and he had great calls. Like, it just felt like, to me, you only could get Smart Money once a month, and everything he said sounded smart, and was well-written, and it made sense to me.
But I think because of his kind of wild hair and his wild personality and the way he speaks, I think average people, like my parents, whatnot, people who are not financial professionals, could relate to him more.
Then I look at the person today, and I don't know him, but I just think about, it feels like an underachievement. Meaning, I'm sure he's entertained millions of people, but I'm thinking, dude, that guy could have been Mark Andreessen.
No, I don't think so.
Fred Wilson? I mean, Fred was his investor.
I don't think, and I have nothing against him. I don't know him, so I have no business saying this, but I don't think he's that great an investor.
I'm not talking about an investor. I'm talking about he had access. I'm not a great investor. In the stock market, I couldn't beat the S&P. I mean, I did, but it was just, I didn't manage huge money, but I hated it.
But you're saying just in terms of someone who could raise money?
I'm saying just in terms of that guy had so much trust built up that I feel it's a massive underachievement.
I see what you're saying.
Meaning he should be running one of the largest advisory firms and VC funds. He had access to people. You don't have to be listen, I became a good investor because Kramer easily was a good investor. He may not have been able to beat the S&P, but as a venture capitalist, he would have been crushing it. He had incredible access.
He's probably as close as it comes to a financial celebrity in terms of like getting stopped in the airport for pictures.
Yeah.
Very few
So
people.
anyways, so that was my entree into it.
Yeah.
The second entree was your firm, Motley Fool. So I was fascinated by Motley Fool because I didn't have Wall Street Journal. I didn't have a Bloomberg. So, back when I was running my hedge fund, I had CNBC, and I didn't like CNBC. And these two guys would come on TV.
Yeah.
What's their names again?
Dave and Tom Gardner.
Dave and Tom Gardner, and they had the hats on, and they kind of made sense, and they were promotional. And I was like, wow. They were like the stock twits or the street. They were like the opposite. They were
going for the mom and pops.
Yeah, they were going for the mom and pops. Tremendous marketers,
Yep.
which I'm not, which they are. And but they made mistakes, obviously, too.
Everyone does.
So tell me about how you got started with the Motley Fool.
Well, to take you back to 2007, kind of the dawn of the financial crisis, I was a junior in college and went to USC in LA. And my plan was
studying
econ.
Okay.
But I mean, I'm not a big believer in the academic prep for the job world. So when I say studying, it's like I don't know, I didn't really do much. But my plan was investment banking and private equity. That was always what I was going to do. And this is 2007, so the world goes to shit. And in that era, if you were graduating around that time, looking for a finance job is terrifying.
Yeah.
There's just nothing available. Like all the investment banks were laying off half their staff, let alone looking for new people. So I actually, and I don't think I've ever said this, but it's the truth. I actually did not think highly of the Motley Fool at the time. I didn't know very much about them. I didn't know very much about them.
Yeah.
But I think what little I knew, I didn't really think that much. And I had a friend named Sham Gad at the time. He was a great investor.
Great name.
Runs it.
Is he a wrestler? Pro wrestler? Sham Gad.
Sham Gad. Okay. He's a great guy, and he was a good friend of mine. And one day I was going through the Yahoo Finance message boards, like for the ticker pages, and I saw an article written by the Motley Fool that the headline caught my attention. I forget what it was, but I clicked on it and I said, "Holy shit, Sham Gad wrote this. My friend wrote this article." And I emailed him and said, "You're a writer now? Like what is this?" And he said, "Oh yeah, I got this little part-time gig with the Motley Fool. I'm writing these articles. They show up on Yahoo Finance so everyone can read them. It's really cool." And then I basically got laid off from a private equity internship that I had. The plan was I was going to stay on full time, but that didn't work out because the economy was blowing up. And so I reached out to Sham, or maybe Sham reached out to me. I forget the turn of events, and said, "Hey, you should become a financial writer at the Motley Fool." I was looking for a job, looking for something to do. Zero.
Okay.
And not only that, but my background before college, I effectively didn't have much of a high school education.
Okay.
I almost kind of went from 8th grade to college, not just because my teenage years were kind of a mess, but that's a different story. But I had no writing background at all, zero.
Okay.
But Sham said, "You're interested in investing, you should write for the Motley Fool." So I applied thinking there's no chance they're going to hire me. But when they did, I thought, okay, I'll do this for a couple months. And instead of staying for 10 years.
Wow. And so do you remember, so who did you report to, or what was the gig? What was your job description?
Well, so I was
what
living
did you have to do?
I was living in LA. Motley Fool is based in Washington, D.C., but I was still at USC at the time. So I was a contract writer, and I was writing one article a day. And that was it.
And you had to write it?
I wouldn't say had to. I was a contractor, so you have some flexibility there. But
what were the parameters of what you had to write about? A ticker?
No. Well, so when we started, it was kind of, they roughly put you into a sector. And it wasn't like this is all you can do, but it's like we would appreciate if you covered this sector. So for me, it was banking.
They would pay you by the hour or by the article?
By the article.
Okay.
And for me, it was banking. And this was 2007, 2008, when banking was like, everything was blowing up. It's usually the most boring industry you can think of, but this was, it was really fascinating at the time. But I wrote about other stuff. And so I did that for a year or two where I was just covering banks and banks going out of business, basically. And then I started really getting interested in the economy at the time because this was the Great Recession, 2008, 2009. So I started writing more about macro issues, just what was going on with unemployment and what was going on with government budgets and the Federal Reserve and whatnot. And that's what I wrote about for years after that. And then that kind of merged into... I got really interested in this idea that the financial crisis that I had been writing about, you could not explain it through any economic textbook. There was no explanation in any textbook that would have explained why people...
Because the math was too big, or because...
No, because the decisions were so irrational, as the economists would have said. Like, there was no explanation for why people were doing what they were doing, but they were doing it. And that's when I just got...
Leading up to it, or
both.
Okay.
Leading up to it, during it, afterwards, or not even that. I'd say all the time, going back in history. There's no explanation. There's no good explanation for why people do what they do. And that's when I started really getting interested in like the psychology of investing. And that's where I think the answers of investing can really be found in. And a lot of that is because I really think most of the analytical side of investing has been solved. Like there's so much brain power in there, so much number crunching. A lot of people do have an edge in there, although the edge has to be constantly updated. But to me, the psychology side is not only not solved, I think it's unsolvable. It's always going to be there. And I also view it as like the base of the pyramid.
Just different layers of edge
right
along that scope of psychological.
Yeah, absolutely. And I also view it as like the base of the pyramid in investing in terms of like psychology is the bottom of the pyramid. Yeah. And if you haven't figured out your psychology as an investor, everything above it, like the analytics and the portfolio selection and taxes, like none of it matters. Because you can be the smartest analyst in the world and the best data miner in the world. Like go down the list. But if you can't wrap your head around greed and fear, none of it matters.
Yeah. And I think what I moved to angel investing was like it removed everything that I was bad at. I would meet the founders, pick the company, and I was forced to just go with it.
Yeah.
And so that removed, looking at prices was my weakness.
Yeah.
Meaning the fact that something could be traded was actually something that was never going to be fixed for me.
Yeah.
Because so I loved looking at the market and doing nothing. But when I had to look at the market to try and beat the S&P and had to do stuff, it brought out all my worst, habits or my worst dark social problems. And then as soon as I moved to angel investing, the world made sense to me. Is because I didn't have to look at prices.
Yep.
So I wasn't worried about what it's trading at.
It kind of forces a longer time horizon too, because there's no liquidity.
Forces you to be a
this.
better investor because there's no liquidity. You have to make better decisions. You have to
lot
write
of times,
checks that are within your wheelhouse, and it forces you also as a professional to pyramid.
Yes.
Which is I can do in the stock market, but I'm never comfortable with it because of the volatility, the day-to-day volatility. So I luckily discovered, angel investing. And it makes the stock market look stupid to me.
Yeah.
I love the stock market, but only as just now what it's good for. It's just a game against other people in levels of psychology. All the people that follow me and want advice, I say, guys, you got to find something. The stock market is for rich people.
Yeah.
And so the best way to do it is just keep investing, dollar cost average into the S&P.
Yeah.
You can try and pick a few stocks if you want. You're probably not going to be good at it. And here's the best strategy for picking stocks. Pick the most overvalued, most liquid stocks. That's what I do.
Yeah.
But not in a position that's going to change my life.
What would you say is your split, not in assets, but in terms of time or curiosity between public and private markets?
With time, I would say it's 50-50.
Yeah.
Because I feel that there's a connection between public and private markets.
Of course.
And prices keep me up on the news, meaning I don't have to read news. I just have to look at the prices, and I can see what's going on. So that's great. That's my hack for the news. I'm not saying I don't guilty pleasure scan news, but every time I do, I'm just sad.
Yeah.
So prices don't make me sad. Even when they're going down, they're signaling to me, like I teach my kids, if you see red 10 days in a row, don't be unhappy. Like, that's a signal.
Must be nice to be that rich. That's good.
Yeah, it's not that I'm that rich. It's that I've learned how to compartmentalize both my investing.
Yeah.
Meaning, I love being able to look at the market all day and not put on a trade.
Mm-hmm.
And I like being able to tell other people that. And I think when we launch our trade app with Justin and the reward system we build in for not doing things is going to be interesting. The way we're developing our brokerage and things, the way Justin's thinking about it, about doing less, because doing less matters. But the main thing for me is people have to pick something for them.
Yeah.
You can't just, because I'm momentum, just even if you like what I do, it's likely not for you.
Right. No, I think that's a really good point.
And so I'd say I'm 50-50 because I feel understanding the public markets is my edge.
Yeah.
Not in terms I'm good at it, but it's my edge in understanding the private markets.
Yeah.
Meaning I see where trends are happening. I see where the holes are. I can see relatively what's happening. Lately, it's the flippening between Robinhood and E-Trade. It's like we're right at that thing where if it flips, like it's hard to grasp. E-Trade's been around so long and has all these great business models.
Yeah.
Has all these assets under management. And, maybe I'm biased, but I think it's happening. Robinhood's going to well surpass the valuation of E-Trade. And it's not going to be based on the metrics that made E-Trade great. It's going to be based on the metrics that make a new social brokerage great. Less people, more software, more trust, simplicity of business model, yada, yada, yada. And everybody's like trying to figure out old metrics versus, maybe Robinhood's overvalued, but, maybe it isn't.
Yeah.
And so that's what makes stocks hard, is because the valuations have the way that you can think about valuations is so many ways.
Mm-hmm.
There's no analyst in the world can describe the leverage and the social global mobile, no one can understand how big these things are or how overvalued or undervalued these things are because they're growing so fast. The reason I like the private markets is for that reason too.
Yep.
At least, I kind of have a feeling about it. I trust the management team. They're growing, maybe 8 billion and maybe 4 billion. But in a public market, if Robinhood was public, I probably wouldn't be able to hold the stock.
Yeah. Yeah. No, totally.
And so the same thing happened with me with Uber. Is like the minute it got to like 10 billion, I'm like, come on. The only reason I let Uber in my portfolio get to 10 billion is because they wouldn't let me sell it.
Yeah.
So that was a great thing too. That was a big eye opener. Is like I would have sold that thing at $1 billion.
So did you evenally sell in the secondary,
I sold at I think it was like a 10 billion.
Yeah.
And the next day Google invested. Like I didn't care, but I'm saying the spreads were so high.
Did you buy it during a round or during?
No, I got it. I invested in a fund, David Cohen's fund. It was a $4 million fund. It was one of the best funds of all time.
Right.
And he put $50,000 in at a $4 million valuation.
Yep.
And so I remember. So I think the equivalent is I had maybe $2,000 in the deal.
Yeah.
At that valuation,
which turned into $7 trillion.
It's a lot of money.
Yeah.
But I sold a lot early.
Yeah.
And then I sold some at $40 billion. And now it looks like okay. I think I'm ahead.
That's probably about where it is. That's probably about where it is today.
Yeah. So in the end, that's about where it is. So, but I'm saying if certain things were public, I would behave way differently.
It's interesting though that your curiosity and your interest is 50-50 public-private, because I feel like that is rare. I feel like most people are one or the other. And not only one or the other, but dismissive of the other side. A lot of
that's my edge then.
Public market investors will look at VCs and private equity and just look at them as kind of like opportunists or gamblers.
Yeah.
And a lot of people in the private markets look at public equities as just you're helping a bunch of mom and pops invest their 401k. It's just not very exciting. It's very accessible.
Shouldn't be exciting. We're starting an advisory firm, and I think most VCs are going to go down this path. I think Andreessen set off what will be some kind of trend over the next 20 years. The next Goldman Sachs will start out as a venture capitalist.
Yeah.
Right, because the markets are kind of done.
Yeah.
With the Vanguard and commoditization. So I think what you're seeing with Andreessen right now is the beginning of a new wave of what a bank looks like.
And I think the best kind of front runner to that is probably Citadel, which started as a pretty small hedge fund, ran out of a dorm, and now is effectively a top-tier investment bank.
Are they an investment bank? So
No,
the order flow or Citadel's getting a piece of.
They do everything. They do everything. They're an exchange. They do everything.
They're a conglomerate and just print money.
Right.
So yeah, they're in another level. But I'm saying the way Andreessen's thinking about it is just a partnership. They're going to end up being trading stocks. They're going to have wealth management.
Yeah.
They're going to be this lean beast built around trust and access. And listen, there's better margins. When you can charge 2.5% in your fund and not have to rape a nation like Goldman Sachs does with Malaysia. You know what I mean? Stealing 6%. You know what I mean? To make your year.
Yeah.
I think there's just a better business model in communicating with your clients. There's fees for this service.
Yep.
And eventually, he who controls the most trust and controls the dollars is going to be able to control the next generation of how they invest it.
Yeah.
And so firms like Andreessen are the new Goldman Sachs, which is exciting.
I'll buy that. Yeah.
And so look at them. Andreessen does love the public markets, but eventually the private markets are going to come over to the public markets. So what I think is all these private people who understand alpha and have seen this are going to slowly get excited about the public markets.
Yep.
I don't know if it'll happen over 10 years or whatever, but eventually alpha will come back into the public markets.
Yeah, I think there's definitely a blurring between public and privates these days because the secondary market in private investing has become so large that even before Uber and Lyft and all these companies went public, or Airbnb right now, which is still private, a lot of those employees still have liquidity through various means because the secondary market is so big.
Robinhood founders have taken some money off the table.
So there's a blur. It's not just binary. You're either public or private. A lot of it is, and even a lot of the big shareholders of these private companies are like Fidelity mutual funds.
Yeah.
Maybe they're not major shareholders, but they're still investors, public investors in these funds.
Yeah.
So that blurring is
which means it's a great time to be an angel investor still. I keep saying, too small to fail, stick to street alpha. All of us young people have an edge because we have our networks and we're seeing things. Whether you're an investment advisor like Josh and Barry, they may not think they can invest in private markets, but they're sitting there with all this alpha because they're talking to hundreds of advisors. They're running events. Yeah. They're traveling the world, and eventually they're going to see a company. And Josh has been making some investments, but they're going to see a company, and it's going to be a layup for them.
Absolutely, yeah.
So
it's just what you see, who you know.
Yeah, and so you're at Motley Fool, and so now you switch your writing to be more about
psychology. I look at it as like the intersection of investing psychology and economic history. That's kind of what I'm interested in, and I feel like where those two things collide.
And is that when people started to enjoy your writing more?
I would say, so I started writing in 2008, and I would say no one paid any attention whatsoever until 2012. Okay. And then 2013 was, I feel like, the first year that people outside of the Motley Fool started paying attention.
And so how did it get outside the Motley Fool? Because I remember starting to read it, but I didn't want to go. I wasn't paying the Motley Fool. So how did I see it? Maybe on Yahoo or something?
No, I'd say the first time it started really getting out, there's a link aggregator. It still exists. I think it's not as big as it used to be, called Real Clear Markets.
Oh yeah.
That was when they started linking.
Good traffic.
Yeah, it's pretty good. I don't know if it's still big. I don't check it anymore.
But Real Clear Politics is big.
That's huge. Yeah. But Real Clear Markets started linking to a few of the pieces, and that just got exposure to other people. And it was Josh Brown who kind of, I think, put me on the radar in 2013.
Yeah.
I remember at the end of 2013, Josh Brown tweeted. He said Morgan Housel and Jesse Livermore, the pseudonymous blogger, said Morgan Housel and Jesse Livermore were the breakout bloggers of the year, and that my Twitter followers quadrupled overnight. I feel like that was, and that's what it needs in this industry. You only need one.
But you're not
sponsor.
Overnight. I understand, but you're not. It wasn't. There's no overnight success.
No, by 2013, I've been writing for 6 years.
Yeah.
But you also need a sponsor, and people, Nick Majuli, these new writers, also had a sponsor that kind of brought.
Yeah,
them
we
in.
give Phil and I. We discovered Josh back in the day, and we just.
Yeah, Josh had his own sponsors by you and Phil. Yeah.
Well, Phil mostly would send me his links, and I was like, "Fuck!" I would laugh and thought he was funny with his blue tracksuits and loved the markets, but didn't know anything. But just was unafraid. And had a different angle. He wasn't Kramer. He was the new Kramer. He didn't care about the market so much. He just cared about the whole marketplace.
Yeah. I think Josh is also equally funny as he is smart. And
Yeah,
he's
I mean,
very
he's super
smarty and very
talented.
smart. And those two combinations don't exist next to each other very often.
He's the only person, I don't watch TV, but he's the only person on CNBC who both sides can put up with. Now, obviously, once you go on TV, people hate you, but he's dealt with it pretty well. I worry about him being on TV because it's always a bad end game, but he seems to be doing well with that, and that's a hard line to toe.
Yeah, oh, absolutely.
Once you
But
put
he's
the
the only
makeup
person
on.
who I think he could be like a legit stand-up comedian, and
Yeah.
I would trust him running my parents' money.
Yeah.
That
So
doesn't
that's for sure. So he outs you. You become a little bit of a celebrity. When the process today, we'll get to your new career, but where you're at now. So you're at Motley Fool, and how does that change?
So I was.
They let you write whatever you want?
Yeah, pretty much. I think that was. In my time at Motley Fool, I wrote almost 3,000 articles, a little more than 3,000 articles, and I don't think any actually got rejected. But that's kind of true for how all their writers work. True to like the Motley part of the name, there's a big variety of opinions, and there's no central company, line that has to be towed. It's a lot of people on the platform disagree with each other. So I was writing a lot, and I was of the 10 years I was there, I was a contractor for 7. I was living in LA and then Seattle at the time, and then I moved out to Alexandria after that, and I was an employee.
Is that where HQ is?
Yeah, and I was an employee in the office for about 3 years.
And
Still
did you like that?
doing the same thing. Yeah, I liked it. So that was the only time in my career that I've been had a desk in an office, because now I work at home.
So you picked up the family and did that.
But yes, my wife went to grad school in Baltimore, so that's what brought us out to the area. And then after she finished Baltimore, we moved to Alexandria.
And so you're doing this, they're paying you, and they're a private company.
Yep.
And an amazing company.
It's great.
What can we say about Motley Fool?
It's bigger than you think, that's all I'll say. Yeah.
And they just have a machine.
Yes.
And the machine hasn't changed that
A lot
much.
of very smart people there, great people that work.
They've made their
there.
mistakes. Like they had
everyone
private
does.
equity, and they had their messes.
Everyone
now they're
does.
a
But I think
tooled machine.
I think they've learned from the mistakes better than anyone else. So when they had
They're
the
back
screw
in
ups,
control of their own destiny.
Yes, but when they've had their screw ups, and a lot of those were public screw ups, I think they learned a lot about it.
Yeah.
And really great people, very very smart people. It was tough to leave, honestly. It was not. It was the hardest thing. I always say joining Collaborative Fund was a very easy decision, but leaving the Motley Fool was the hardest decision of my life. Even though those were one and the same, I'd split them up into different categories.
How did that come about?
Well, I met Craig Shapiro, who runs Collaborative Fund, in 2015.
And he's New York.
He's based in New York, San Francisco, kind of splits his time. So he reached out to me in 2015 and said, "Hey, I read your stuff. Let's just grab breakfast sometime." And I said, "Great." And it was just, so I just got to know him, not in a "Hey, do you want to come work for Collaborative Fund?" Just let's just get to know each other. And I think Craig and I see the world through a similar lens. That was pretty obvious right away. Just things that are important to me are important to him, and vice versa. So I just really took a liking to him, and so we got to know each other over the course of a year or two, and then that started the conversation of what if I came and wrote for Collaborative Fund, which didn't make a sense to a lot of people, including me at first, and my family, and a lot of people, people who Craig knew, because it was a seed stage venture capital firm, and I was a public markets writer. It didn't those two things don't really go hand in hand very often.
Right.
But something that was really important to Craig is, what really matters in venture is, because money is fungible, and there's a lot of money out there. Your ability to write a check does not set you apart anymore. Okay. Everyone's got a checkbook. Yeah. There's 1,000 VC funds.
No doubt.
So what really sets you apart is what do people know about you? Do people know who you are? Yeah. What do you stand for? Yeah. What are your values? What is your vision? And none of those things matter unless you're putting them out to the world. Yeah. So the idea was that if I would write, hopefully, things that people want to read, it would draw more attention to Collaborative Fund and just kind of elevate the brand. And even what I write about is not necessarily relevant to our portfolio or even venture. It's, again, the intersection of history and psychology. But the idea, hopefully, is that it'll just draw attention to what we're doing and the values that we stand behind, and just put a bigger spotlight on the team and the portfolio.
Well, that part of it has been a success, but is it something that... because that's obvious, it's a success. But how do you then day-to-day manage how that fits in with the company?
I would say there's not, I don't know how to answer that, because I don't think there is a day-to-day strategy. My whole strategy
There's
is...
no measurement, just be Morgan.
We measure, I think that's effectively it, yeah. I mean, all I think about all day is what am I interested in? What is an insight that I've enjoyed, and how can I share that in a way that will hopefully capture people's attention? That's effectively all I think about.
And you're not writing checks for Collaborative?
No.
And you don't want to write checks. I know you started out, we were talking about deal flow and stuff, but you just don't want to do that.
Pretty much all that's in my blood is writing and speaking. That's all I want to do.
And how did the speaking come about?
So when I was at Motley Fool had a bunch of conferences, 4 or 5 a year.
Oh, okay.
So I started off just doing a couple panels. I started interviewing people.
Okay.
And I actually had a thing with the CFA Institute for several years where I was kind of their go-to.
Did you like it?
Yeah.
You like interviewing?
I was kind of their go-to interviewer. So I was interviewing other people for CFA conferences. Probably interviewed dozens of people at CFA conferences. So that's how I got comfortable on stage. And then I started doing keynotes for the Motley Fool. And a video of that found its way to the Washington Speakers Bureau, which is a speaking agency. So then they brought me on the platform in 2016, and then I started speaking at a bunch of other conferences.
There's a whole other world out there, huh?
Yeah, it's something I never.
How do you decide what you're going to charge?
You just pick a big number. You just put it on the table.
Yeah,
no, there's a market.
Like
there's a market for it.
I've never gotten paid for it. I've gotten trips and whatever, but I guess you just throw a big number out. If they really want you, they should pay.
Yeah, and there's various conferences have different budgets, different means and whatnot.
Of course.
But there's a market out there.
Yeah.
And there's obviously a big range of speakers, and there are a lot of free speakers, but I think you usually get what you pay for that kind of thing.
Yeah,
but it's been great. So I do several dozen talks a year now.
Yeah.
To become very much like writing, where it's like I never planned this. It was never part of the idea. It just kind of happened. That was my background with writing. And then speaking, so I really started speaking in 2016. That was the first year. And actually really 2017. I think I did one talk in 2016. But if you had asked me in 2015 whether I'd be doing this, it would never in my wildest dreams was this ever part of the plan. And now it's half my time.
And what about routine as a writer and a thinker and a speaker? What's a daily routine like?
So I don't know if this is advisable, or if this would be my advice for people,
Yeah.
but I really don't have any routine.
Okay.
And I don't sketch out article ideas. I don't, I don't sit down and outline an article beforehand. I just something that's interesting to me. If I can, what is this one little nugget of insight that I think is interesting, and how can I write a story around that in a way that's hopefully going to be somewhat entertaining for people and contextualize that piece of that insight in an interesting way.
I think that's the same thing for me. I can't force it.
But pretty much, even though I've been a full-time writer now for 13 years, the routine is basically wake up Monday morning and go, oh shit, I got to write something this week. What am I going to do?
But to get you going, you read.
It's mostly reading.
Yeah.
Spend the majority of my time reading.
So me too.
And I go for a lot of walks. I spoke with Patrick about this on a podcast a couple years ago, and that's where I quote unquote write most of my articles. It's just going for walks. You just sit at your desk and try to grind the gears in your head. I just think it doesn't work.
No.
So for me, it's kind of a lot of reading, and then I got a little bit of an idea, and then it's like, okay, let's go for a walk, and that's where things start spinning.
Okay.
And then I'll take notes.
And are you
a
runner or?
I run seasonally because I live in DC, so it's
fitness,
it's too hot in August, too cold in January.
Okay. And so then how do you invest?
So I've written about this too. My entire net worth is a house, a checking account, and 3 Vanguard funds. That's a pretty much. Let's call that 95% of my net worth.
So you just save money in the Vanguard funds.
Dollar cost average into Vanguard funds. Been doing that forever, and that's
I think 99% of people can do that too. That's
all.
Of course,
it takes no brain power. And I think what got me into that is my parents, but my really driven by my father, who kind of manages the money. My parents have dollar cost average into Vanguard funds for 35 years, never sold a single share. And they didn't do that because they had a grand insight or that they knew this was going to be a great way to invest.
And they suffered big drawdowns along the way.
But they've also, if you were to compare them to hedge fund managers or mutual fund managers, they'd be top quintile.
Yeah.
And they've done nothing.
Yeah.
And so viewing that to me was really powerful. And it was also a thing that just because they've been doing that, all of their goals are met.
Yeah.
And so that was for me. If I can start doing that at a young age, the odds that by the time I'm 60 or 80 or whatever, that I'm going to look back and have not met any of my financial goals, to me, the odds of that round close to zero. So it's well, that's what I want to do. Yeah. And I think a lot of the people who want to beat the market are doing that because they need to. Yeah. Because they need to do it to meet their goals. Doable. But if you can start young and just dollar cost average into index funds, you don't need to.
Which is why I think the business is changing. Meaning the joy is, like you just said, 99% of people who dollar cost average or beat everybody.
Yeah.
There will be drawdowns. That should be the title of an investing book. I'm going to write that down.
That's a good one. Yeah. I'm going to take that's my next article. I'm going to take it.
Okay. There will be.
We'll
work on it together.
Yeah, that'll be fun.
So There will be drawdowns. This is why I feel like Andreessen's got the right model, and why I'm building an advisor as well as our social leverage. Is you've got this trust, you've got margins, you're charging 2.5 and 20. There's returns to be had in angel investing, but really the real joy is asset allocation. The other part of the world, the vanguardization of the world, is the thing.
Yeah.
Like the S&P is the S&P. Like it's the markets are the markets. Like why try and beat them? Educate your clients that like the best investment in the world is just dollar cost average. It's just a nice thing to have that luckily the markets exist.
And I think a really important thing for your personal financial philosophy is this idea of enough.
Yeah.
Of just like the market return is enough.
Exactly.
And like if the market's going to return 8%, like, yeah, it would be cool if I could get 10%. Like, I'm not saying that's bad, but 8% is enough for me. Yeah. I honestly view exercise the same way. So when I do run, I run 3 miles, and I've been doing that for years. I never run more than 3 miles. And I have a lot of friends like, why don't you try to do a half marathon, do something else? And my philosophy is like 3 miles is enough. I'm not trying to become the world's greatest athlete.
Riding too, people go, do you have a heart rate machine? I go, no, I do it for meditation. I do between 1 and 2 hours. I know what the calorie burns are. I know I can stop for McDonald's.
Yeah.
Like I'm not looking to be the fittest cyclist in the world.
Like
I'm
whatever.
Looking for other reasons of why I ride.
Yeah.
And so luckily I think that way. I try and teach other people to think that way too, because enough is an important word. Write that down too.
Whatever the opposite of a type A personality, swing for the fences is me.
Well,
I think a philosophy for a lot of my stuff in life.
Well, I think you're seeing at the Collab Fund, there is a point where things line up, more so in the private markets than the public markets, because you're just smart and you have a network. And I do think people should swing, but I think they should swing along the street level, like with people and betting on people, not on these blind companies that are can't understand the financials. Like, why kid yourself? Yeah. You're a part of this machine at the public markets, and I agree with you. The market it's fantastic that there is an index. Yeah,
and I guess for my
you go ahead and try and beat it. I'm all for you trying to beat it. Understand though the odds are low.
Yeah. And for me, what is really important in my personal investing philosophy is what I really want to focus on, that I need to focus on. It's integral to what I'm doing, is endurance. Yeah. I just want to make sure that I can stick around for 20 or 30 years. Because if I can stick around for 20 or 30 years, then whatever the market return is, or let's say 40 or 50 years, whatever the market return is not going to be good enough. It's going to be absolutely sensational. Mm-hmm. So if you can take 8% and hold on to it for 30 years, or 10%, but you're going to get knocked on your ass and get scared out of the game, or leveraged and blow up. Like, it's obvious which one you should take, but it's hard for people to accept that. So if I can spend none of my time thinking about asset allocations and sectors and stocks, and spend all of my time thinking about endurance and psychology, that's what works for me. It might not work for everyone, but for me, that's what fits what I do.
All right, so wonder on that. Since you like interviewing, do you have any? Give you 1 or 2 questions for me if you want.
I don't know everything about you. No, nothing. So, Howard, let me turn that around. How do you invest your personal money?
I think it's pretty much I'm coming to that conclusion, right? I love owning stocks, but I don't like having all my money in stocks, right? Because I have so much invested in, trying to have a normal life, the balance. Yeah. And stocks never have brought me balance. I mean, I get my kicks out of stocks by writing about it and have a newsletter and talking to people about 1 or 2 ideas a month that could boost their returns. So I believe in indexing. I believe if you don't index, you should at least closet index, meaning put 90% of your money in indexing and take 10% of your money and try and beat the market.
Itch of having fun. Yeah.
Yeah, like you won't crush yourself.
Yeah.
Like don't. Like I get all these kids that are emailing me. It's like, oh, these stocks are down 20%. I'm like, dude, if this is what's bothering you, take this as a sign. Yeah. This is the way it is. Yeah. Like, why are you torturing yourself? Torture yourself with a little bit of money. Yeah. And enjoy the fact that there's indexing. So I really believe in it. Yep. I just don't necessarily believe in the way they're selling me an index.
Do you have any index funds?
No. None. Because I don't believe in the product that it exists today. I believe in the market return. Yeah. But I also believe, and this is what I'm going to talk to Patrick about, in the fact that I hate the idea that Vanguard's decided for me which 500 stocks I own.
Absolutely. And I think Patrick's going to obviously have some interesting stuff about that.
So it's the most fascinating thing that I've been writing about for years, which is like, tell me what my returns would be. Motif, all these companies have started and they've just been inches off. It doesn't take much to be off, but it goes off in massive scale when you raise tons of money and your idea's just a little bit off. If you raise a little bit of money and your idea's a little bit off, that's fine.
Yeah.
You're a little bit off. You blew a little bit of money, and you can right yourself. When you raise $100 million and you're a little bit off, holy fuck. By the time you get it, it's over.
Yeah.
Because you've got so much moving in one direction, which is my problem with angel investing. Why should you get $5 million when you can actually prove the first thing with $1 million?
Yeah,
like,
right.
Give you 5, you burn 4 to figure out the same thing that you would have done with 1.
Exactly.
So
and not only that, but now
that's
you're
why angel investing makes sense to me.
Not only that, if you had 5 when you should have 1, now you have no spending discipline, and you went and got a glass-walled office.
And we're seeing all the effects of that.
Yeah.
It's this chase to be the number one, can lead to bad things.
Absolutely.
So I really believe in like pyramiding and like starting from a corner of the world, like the game of Risk. Like you win the game of Risk not by starting in Europe, where you're attacked by everywhere and you got to protect all these borders. You win by starting in Eastern Australia and slowly move your armies. That's how the startup game is won. You wedge in and then you can explode. When you see an opening, you explode. You pour money into that wheel. But in the public markets, it's way different. So what fascinates me is being able to explain that to people and try and get them to a point where the faster I can teach them that stocks are fun, but indexing is cool. My problem with indexing has been I agree with low fees, I agree with everything, but why do I have to have these 500 companies?
But do you think not to get too nuanced?
So go ahead, sorry.
Not to get too nuanced about it, but is Vanguard picking the 500 stocks that you should own? Or like they're not saying we think you should own Amazon. They're just saying Amazon is big and you should own big stocks.
Well,
it's a little more nuanced, but
it's way more nuanced. But what I'm saying is everybody's tried to help people pick their own ETF, which is no different than picking stocks. If the market return is Vanguard 500, and my client says I can live with 500, and I can ask my client, say, is there like 2 companies like
that you hate?
Yeah, is it
what Patrick
tobacco?
Spoke about yesterday,
I've been like writing about this for years. Like, well, we've institutionalized Vanguard has institutionalized bad behavior, meaning Wells Fargo can rip their customers off forever and ever because that night when the indexes are rebalanced and Betty Lou puts her money in the S&P 500 fund, right? Just does it like a machine. She's institutionalizing bad behavior because the next morning
she's propping up Wells Fargo stock.
Money's flowing into Wells Fargo stock.
No,
so this is the real problem with ETFs. They can talk about bubbles or not. What we've created with Vanguard by vanilla and chocolate, or just vanilla. I don't know when it ends, but I am of the opinion that that's the problem of indexing, is we've let these companies, just Equifax, Experian, Facebook, if you can't punish them because money's flowing in at the end of every month, then how are you going to change behavior?
I think the devil's advocate to that, and this has been brought up a bunch in the last 2 weeks when there's this idea of a bubble and passive, is that I haven't seen much evidence that price discovery or the ability to punish a company doesn't exist anymore.
So you're saying I'm wrong?
Yeah. I mean, look what happened to Netflix in 2011, 2012. Stock fell 80% because they screwed up. Like, that still exists. And Netflix was a big company. They came out with Quickster, the idea they're going to spin off the DVD business. Stock fell 80%.
But maybe it would have fallen 99%.
Does that make much difference, though? I don't
know. It makes
a
lot of difference. Again, I'm talking about, this is all empirical. What I'm talking about, again, I can't prove any of this stuff. But I believe that if these companies remain in the S&P 500, what's their point of change? There's no way Wells Fargo, if they didn't have money flowing into it every month, would still even be, I think, a recognized name. Netflix, again, I don't know outliers, but what I want my clients, or what I would love for people to have, instead of recreating the whole thing, let's just see what the returns would be like without these 5 companies.
No, I think that's
much
great.
easier than building your own fund. And if I could tell my clients, hey, we could take out these companies with bad customer support. They treat their customers badly. We think they have a fake monopoly, yada, yada, yada. And our returns are the exact same as the S&P over the last 30 years. Maybe you'll feel a little better about yourself.
And I think
that's about the edge of what I think is possible.
Yeah, and I think if you feel better about your investments, even if taking out Wells Fargo pretty much makes zero statistical, if you feel better about it, if that gives you more endurance, to come back to my point, that's a big deal.
So if that's enough. Like if that would be enough for me, it's like I get to at least penalize them because that's gross what they did. And if I knew that my returns weren't going to suffer massively, That would make me feel like I was in control of my finances just a little bit.
Yep.
That would give me the endurance
I guess
and
how
the
I look
ability
at
to survive drawdowns.
how I look at indexing too is I don't even think about the companies I own. Most of what I own is Vanguard Total Stock Market Index, which is 3,000, and I never think about the companies. As I look at it, it's just owning a slice of capitalism.
Yeah.
I just own a slice of like productive assets.
Not arguing with
and
it.
if you think about it as less about the individual companies,
Yeah.
like I don't care what's in there. I just own a slice of the economy, and
No,
I'm
and
betting
that's-
on humanity.
But this has shaped how I invest in the private markets,
Yeah.
meaning I believe in Robinhood, but I also believe in Vanguard, and I haven't invested in between the two because in between the two is like build your own ETF,
Yeah.
do all this fancy stuff, and I really think the only thing missing between the two, it's not about robo, it's not about fees, it's about a small change in behavior, right,
Yeah.
that helps you ride the waves.
Yep.
Because there's stock picking and there's indexing. Indexing needs to be tweaked a little.
Yep.
And Vanguard could offer this. They have the technology. They have the fractional shares. You should be able to go to Vanguard and say, here's the stocks in the Vanguard 500. Deselect 3, see what the returns are, put that money to work.
Yeah. I think when you're talking about
So
Vanguard,
they
where
could
so
create the
many of
product.
their clients are people who just want absolutely nothing to do with investing.
I get
don't know.
it.
Yeah.
And so maybe they're doing the right thing, but there's going to be a company like a product that comes along that allows you to deselect a few companies, see what your returns are, feel a little bit better, and give you that endurance. So
Totally.
that's one question.
I've told a couple people about this as well. My mom a couple years ago was going off on Monsanto. Maybe justified, people have different views, but she was really upset with what Monsanto was doing. And I pointed out, I said, you own Monsanto in your index funds. And she was, her jaw hit the floor.
Yeah.
And she wanted to, I think, sell the funds.
Yeah.
So
And
like,
then what
so
are her
for
choices?
someone like her,
There should just be a choice where she goes to the website, you could do this, and
Yes.
see and just make a choice.
Right.
It doesn't have to be a life-changing choice where they panic and
Yeah.
freeze, but she shouldn't be returned off investing because she's supporting Monsanto.
I agree. Yeah.
Okay. So anyways, thanks for coming on the show.
Thanks for having me.
And we'll have you back again. Hopefully, I'm trying to think. We've covered your writing, Motley Fool, collaborative fun, your speaking, the kids. Sounds like life is good.
Pretty good.
Okay.
Can't complain.
All right. Thanks for coming on.
Thanks for having me.